There are other ways to prepare financial statements other than by following generally accepted accounting principles. These other ways that are used are called special purpose frameworks. They're also referred to as other comprehensive bases of accounting, because once you have a simple name, what do we do as accountants? We add a more complex name to something else. The most frequently used special purpose framework is probably the cash basis, and this is the one that we're going to focus on in this video. There's also something called the modified cash basis, where we don't just look at cash inflows and outflows, but we also add some accruals, typically plant, property, equipment, and depreciation expense, perhaps inventory and cost of goods sold. And then there's the income tax basis. Now, none of these are GAAP. So publicly traded companies or companies with publicly traded stock, equity, or debt bonds are not going to be able to prepare financial statements under these methods. Think more very small companies or individuals who have their own companies. They might be choosing from one of these three methods. They might be asked by a lender, specifically a bank, to take their cash basis financial statements and then put them into accrual basis accounting or financial statements that follow GAAP. And that's what we're going to be looking at in this video. How do you take cash basis financial statements and convert them into accrual basis financial statements? So what the cash basis will look like, as you can already imagine, your revenues are going to be recorded when you receive cash. So your income statement is going to show cash receipts less cash payments. Think of how much easier your lives would be if this was the only accepted method. No principles of financial accounting, no intermediate 1, 2, no this class. Aww. This is different from what we know as the accrual basis financial statements or generally accepted accounting principles, where we have our revenues recorded when earned, meaning your goods have been sold to the customers, or services have been provided to the customers, and expenses when one of a few things happens, either when they're incurred, we used our utilities for this month, and at the end of the month we got our bill, so we record that expense. Sometimes these expenses are matched with a related revenue, like depreciation. We're using our buildings and equipment over time to bring in our revenues, so we match it. Or bad debts expense. We had sales this period. Some of those sales will never be collected, so we have bad debts expense. And then another way of talking about depreciation is systematically over time. Depreciation, amortization. And that would be your revenues, your net income under the accrual basis. Let's take a look at a really simple, straightforward example under our examples for this video. Assume that quality contractor signs an agreement to purchase, to construct a garage for $22,000. In January, the company begins construction, incurs costs of $18,000 on credit. By the end of January, delivers a finished garage to the buyer. In February, collects $22,000 cash from the customer. In March, the company pays the $18,000 to its creditors. Prepare the income statements for January, February, and March under the cash basis and the accrual basis. Start with the accrual basis. That's what we're used to. So in January, they begin construction. They incur the costs. So we have the expense in January when the cost is incurred. And by the end of January, they deliver the finished product, the garage, to the customer. So we're also going to record the revenue of $22,000. And so we would see net income or $4,000 in January, nothing in February, nothing in March. Let's look at how this differs under the cash basis. We have our cash receipts. We're going to record the revenue when we collect the cash from the customer. In February, the company collects $22,000 cash from the customer. And then our expenses are going to be our cash payments. In March, the company pays $18,000 to its creditors. So what we're going to have for net income, we're going to have nothing in January. We're going to show a full $22,000 of revenue in February when we receive the cash from the customer, and a net loss when we paid the cash payment in $18,000. So we can see we violate the matching principle here, and we're also recording the revenue in a different period. Our goal is to be able to convert financial information on a cash basis into the income statement on an accrual basis. It's going to be exactly the opposite of what we've done in the operating section of the statement of cash flows. So let's just take a quick look at an example, and then before we work through the example, we'll write out our notes and then come back and finish the example and look at a few others. Jill Accardo, MD, maintains the accounting records of Accardo Clinic on a cash basis. During 2020, the doctor collected $142,600 from her patients. Okay, so we have our cash revenue and paid $55,470 in expenses. There we have our cash payments or cash expenses. And then we have clearly when a company is converting from the cash basis to the accrual basis, they've got to already have or be able to prepare some of the accruals and deferral accounts. So here we have accounts receivable, and we see the beginning and ending, so we can calculate the change in the balances of accounts receivable. So we know what to do. If accounts receivable, let's see, they go up during the year, that must mean that the company recorded some revenue on account that's not included in the $142,600 cash received from customers. We have a change in unearned service revenue, the liability account, accrued expenses, also a liability account, and prepaid expenses, an asset account. So let's review what these rules are so that we can convert. Instead, with the statement of cash flows, we were converting the net income into cash from operating activities. Now what we're going to be doing is converting cash receipts into revenue under an accrual basis, on an accrual basis. All right, so two very similar methods that we can be using. It's not even really different methods, just sort of different mathematical formulas to use here. Regardless, we're going to start with our cash receipts. And then what we can do here is subtract out the beginning balance in accounts receivable and add the ending balance in accounts receivable. This is going to be one of our adjustments to cash receipts. Another way of saying this is to add any increase in accounts receivable or subtract any decrease in accounts receivable. So why is that? If accounts receivable went up, this meant revenue was recorded on account, and that means revenue on an accrual basis increased, but no cash was received. Or we can think about the journal entry. An increase in accounts receivable means a debit to accounts receivable. And so what does that credit have to be? Every time we debit accounts receivable, we're going to credit sales revenue or simply a revenue account. Okay, and if accounts receivable decreased, if we recorded a debit to accounts receivable, or we're reducing accounts receivable, what must have happened? We must have collected cash. So here we had no cash receipt, but we did have revenue, and here we had cash receipt. So to subtract out the decrease, because cash was received, so cash revenues went up, but there was no offsetting revenue on an accrual basis, so we need to subtract it out. All right, so we take our cash receipts, we adjust for the changes in accounts receivable, and then we also adjust for changes in unearned revenue. We're going to add beginning unearned revenue, and subtract ending unearned revenue. And this is equivalent to saying, so method 1, this is kind of like method 2, but remember, again, we still have to start with our cash receipts. Okay, our changes in unearned revenue, we say we subtract an increase in unearned revenue, because if unearned revenue went up, then what happened? If unearned revenue account liability went up, we'd have to credit unearned revenue. And what's the only thing that happens where we credit unearned revenue? This means that cash was received. Cash was received in advance of providing the goods or services, so we now owe them. Cash received means that our cash receipts went up, but no revenue was earned, so on an accrual basis. So we need to subtract that out. Or, right, unearned revenue is either going to go up or down over the period. If it went up, if unearned revenue went down, we're going to add that to our cash receipts. So if there's a decrease in unearned revenue, that would be unearned revenue is a liability account, so a decrease would be a debit to an unearned revenue. In other words, why would unearned revenue decrease? It must be because we provided those goods or services that we previously owed. We no longer owe them, we're recognizing some revenue. And if we're recognizing revenue on an accrual basis needs to be added because it was not included in your cash receipts. Okay, so either way, we're going to come down to our revenue on an accrual basis. This is our revenue under accrual accounting. Either way. Now we need to look at converting our expenses from a cash basis to accrual basis. And we're going to do this 2 different ways. We're going to convert our cash payments for inventory into cost of goods sold. And then separately, we're going to convert our cash paid for operating expenses, aside from inventory, into accrual basis operating expenses. Inventory or simply purchases into cost of goods sold. Okay, so we're going to start with our cash paid for purchases because it might not necessarily be inventory, it might be the raw materials. We can subtract out beginning accounts payable and add back our ending accounts payable. Now this is equivalent to saying add an increase in accounts payable or subtract a decrease in accounts payable. All right, what do we do that? Okay, this is going to look a little bit weird, but just trust me for a moment. When accounts payable goes up, we credit accounts payable. And why would accounts payable go up? Well, we must have bought something or incurred an expense. And so if we're talking about purchases, let's say we're buying finished goods, and so we debit the account inventory. Now you look at this and you say, well, inventory is not an expense. There's no cash payment here. And there's no expense here, so why do we need to make an adjustment at all? Well, we're going to have another adjustment here for inventory. We're going to do something similar. We're going to adjust out our inventory. And if inventory did go up during the period, let's say they went from no inventory in the beginning of the period, and then they bought inventory, well, we're going to subtract out that change in inventory by adjusting for the inventory account next. So it would be net flat. There would be no net adjustment. But if the inventory account didn't go up as much for the period that accounts payable went up, what would that mean? It would mean that the company sold some of that inventory. So that's what we're trying to capture with our two adjustments. And this is just the first one that we have here. Okay, if we see a decrease in accounts payable, why would accounts payable go down? It must have gone down because the company paid cash, but there's nothing here related to an expense. So we would have a cash payment, we would be reducing or have higher purchases with no offsetting expense. So we're going to need to subtract out that decrease in accounts payable to basically undo it. All right, now again, our next adjustment is going to be for inventory. Add the beginning inventory and subtract out the ending balance in inventory. Similar to the way that we did the statement of cash flows, but everything opposite here with their adjustments from the statement of cash flows. We would subtract out an increase in inventory. Okay, so if our inventory went up, what would have had to happen to the other side? If our inventory went up, either accounts payable went up, and that's what we have here, or we paid out cash. And so what happens? If we paid out cash, we recorded that as an expense under the cash basis, but it would not be an expense. So we would reverse it or back it out with this subtraction here by subtracting the increase in inventory. Or if our inventory decreased, assuming nobody stole that inventory from us, we must have sold it. So the other side of this entry would be cost of goods sold, in which case we have an expense, but we have nothing happening to cash here. So we need to add to our cash purchases, which did not account for the inventory that was sold here but not paid for. We're going to add that cost of goods sold to get to our cost of goods sold on an accrual basis. So regardless of which method you're using, cash purchases, we get to cost of goods sold at the bottom. And one more set of adjustments. Now we're not going to go through every single type of expense one could see, just these two basic expenses, cost of goods sold and general cash paid for operating expenses. So converting cash paid for operating expenses to accrual basis operating expenses. Okay, so we have our cash paid. Start there, and then we are going to subtract out beginning accrued liabilities or accrued expenses. Accrued liabilities, accrued expenses mean the exact same thing. And again, what is accrued liabilities or accrued expenses? These are just miscellaneous amounts owed, generally no interest. They arise from just running your company's business. Picture things like salaries payable, wages payable, bonuses payable, interest payable, income taxes payable. Company might lump all of those things together and report it as accrued liabilities or accrued expenses. Subtract out the beginning and add the ending balance. Okay, so this would look like this is equivalent to adding an increase in accrued expenses, or accrued liabilities. And why is that? Why would we add an increase? So accrued liabilities, why would that increase? Credit accrued liabilities or accrued expenses. What must have happened on the other side? We must have had an expense that was recorded, like salaries and wages expense, interest expense, income tax expense. And now we owe that amount. So it's not captured in the cash paid, but we did incur it, so we need to add it to get to our operating expenses. So add the increase or subtract the decrease in accrued expenses. If we had subtracted, if our accrued expenses decrease, then what must have happened? We must have paid out the cash. There's the only reason to decrease a liability account. We probably paid out the cash. So in this case, if we pay out the cash, that would be included in the cash paid for operating expenses, but there's no actual expense here. We just see a reduction of a liability. We just paid off a bill. So that's why we subtract it out. Okay, so one more adjustment that we need to make, we adjust for our accrued expenses, and we adjust for changes in prepaid assets or prepaid expenses. We're going to add the beginning balance in prepaid expenses. Another word for prepaid expenses is, or another term is prepaid assets. This refers to prepaid rent, prepaid taxes, prepaid insurance. Those are the big ones. And subtract out the ending balance in prepaid expenses. And this would be equivalent to subtracting out an increase in a prepaid expense or prepaid asset. So if your prepaid asset increases, you would debit it, and the other side of it, well, it's prepaid, so the other side has to be cash. So we know that if cash was spent for this asset, it was recorded as an operating expense on the cash basis, but there's no expense here, so we need to subtract it out, not include it. Or if there was a decrease in the prepaid expenses, that means we must have used it up. So we would credit the asset, prepaid asset or prepaid expenses, and the other side of this would have to be something like rent expense or insurance expense or tax expense. And we would want to add that back because it was not included in the cash paid, nothing about cash here, but we did have the accrual basis expense, so we put it in. And then we have our operating expense on an accrual basis. Last thing to note, if there was any depreciation or amortization, we would have to adjust for that depreciation or amortization. So if we're starting with cash, there would have been none. And if we see depreciation, we need to start with the cash paid for operating expenses, nothing. So we need to add depreciation expense to calculate expenses on an accrual basis. Or if we're going from cash-based income, then we need to subtract depreciation expense to calculate net income on an accrual basis.